Jimmy, thanks. So, as Ashley mentioned, we're going to talk about capital markets, and I think Jimmy's lead-in is a great foundational resource for building an understanding of capital markets. So, when we look at capital markets, I think a lot of people tend to think that these are big, complicated places occupied by major corporations, big investment banks, very wealthy families, et cetera, et cetera, et cetera. The reality about capital markets is that everybody everywhere, a younger person, parents, grandparents, corporations, small, large, medium-sized, are all capital markets participants. Simple things like putting money into a checking account, putting money into a savings account, spending money on a credit card, putting money into a retirement account. All these things add up to the global capital markets and the trillions and trillions and trillions of dollars that are traded every day. So no matter where you are in the world, everything you do impacts the capital markets in one way, shape, or form. Maybe not as much as Goldman Sachs or Morgan Stanley or Allianz do, but believe you me, everybody everywhere is involved in the capital markets. Simplest transactions are the foundations of the capital markets. And as Ashley said, as a segue from what Jimmy was talking about, capital markets are incredibly important to the growth of corporations, for corporations to fund themselves. And remember, these things just don't benefit CEOs and CFOs and the people at the top of companies. Corporations fund themselves in order to pay their workers, to pay their suppliers. The capital markets keep the global economy running. When McDonald's needs to pay the millions of people who work for it around the world, they just don't take it out of profits. They borrow money on a very short-term basis from investors, and they pay their workers. This is important stuff. It's the lifeblood of the global economy. So while the corporation, as Jimmy said, is kind of the foundation for the economy organizationally, the capital markets are what feed corporations the cash they need to keep going. So what else do capital markets do? Capital markets just don't help fund corporations, even though that's one of their primary objectives. Capital markets also put together investors, that is, people who have, extra cash, together with the people who need it. So if McDonald's, as we were just saying, needs a short-term loan through an instrument which we call commercial paper, in order to pay its workers, McDonald's has to find someone somewhere who's willing to lend it money on a short-term basis, 3 months, 6 months, whatever, in order for it to pay its workers. And fortunately, there's millions of people, thousands of people, hundreds of thousands of people, and institutions around the world who meet in the capital markets and exchange cash for stocks, for bonds, for short-term commercial paper. So investors look for financial instruments in which to invest. And while the capital markets aren't really a place like a shopping mall, they're really an online platform. Now, at one point in time, they were a physical place. Look, the New York Stock Exchange still exists, and there's still some transactions. And if you go back a couple hundred years, more than a couple hundred years, maybe 250 years at this point, there were, people did used to meet under a buttonwood tree at the corner of Wall and Broad, and they exchanged scraps of stocks for cash. That's kind of where it physically started. In Japan, there was a rice market where rice was grown in Kyoto, but it was traded in Tokyo, and they actually used mirrors to transfer prices back and forth between Kyoto and Tokyo. So even before all the technology that we had, people were very ingenious about creating fundamental capital markets. But nowadays, capital markets are online platforms, not dissimilar to eBay, not dissimilar to Amazon, where people exchange cash for financial instruments. And by the way, we also inform each other over these online platforms. What are the prices of stocks? What are interest rates and all that? So they're not really a place. They are a market, but they're not really a place. They're online, as is what we're doing today, and many other things that happen here in the 21st century. So financial markets, capital markets facilitate the exchange of cash for financial instruments. So what are the types of investors? Who are the people who have cash? Who are the people who have money to invest? These people are individuals. As we've just said, when you put money into a savings account or a checking account, you're helping a bank create loans for its customers, or you're saving money for some future a thing you want to achieve, buying a house, sending your child to college, whatever the case might be. So individuals are extremely important components of the capital markets. We just said banks are important. Banks have excess capital. They have your money in the form of deposits, and they lend out that money, or sometimes they invest short-term in the bond market. Insurance companies, I think for most of us not always daily involved in the financial markets, we might think of just insurance companies as people who just insure us against car accidents, problems with our homes, liability, things of that nature. But in reality, insurance companies, with the premiums that you pay them every month or every quarter to insure something, they invest that money, trillions and trillions of dollars around the planet. Insurance companies are major investors in the financial markets. Pension funds, these are organizations set up by governments and corporations designed to take money from either a government or corporation or individual right now, invest it for a very long period of time, and at some point in the future, when a person retires, that person is paid some sort of retirement income or some lump sum amount, as we call it, at the point that they retire, to help with their retirement and enjoying their old age. So those are the people who have cash, and they need to put it someplace. Because obviously, if you just leave cash in your mattress or in the drawer, it doesn't do anything for you. So what do? They need to meet borrowers in the financial markets. Individuals, sometimes people need to borrow, as we said earlier, to fund for college, to fund for the purchase of a home, the down payment on a home, or whatever the case might be. Some people are fortunate to have extra income, extra capital. They invest so that they can make more money into the future. Corporations are borrowers. As we just said, McDonald's frequently borrows short-term in order to pay its suppliers, to pay its employees. Multiple companies around the world do that. Corporations will also borrow for longer-term projects, factories, office buildings, perhaps to fund research into a new drug or a new type of semiconductor. Governments are significant borrowers as well. Most governments around the world tend to run some sort of deficit because they tend to spend a bit more than they tax, but governments are doing essential things. We pay for police, we pay for firemen. At the central government level, we also pay for social security type benefits and medical benefits for older people. So governments are significant, perhaps the greatest borrowers in the global financial markets. So again, as you can see in the little illustration there, we have the buyers and the investors and the borrowers rather meeting online, virtually, to exchange cash for financial instruments, so that the borrower can go ahead and do whatever it is they have to do, and so that the individual, the banks, the insurance companies can realize whatever investment objectives they have in mind for themselves. And of course, those vary person to person. So as we said, and we kind of covered this already, individuals borrow to buy a house, pay for college, buying a car or another expensive purchase. Cars, of course, are not cheap. Pay for home improvements is a significant marketplace in the United States and in other countries, and it's a significant driver of economic activity. If you are adding an addition to your house, you have to pay the workmen, you have to buy equipment. All this stuff is what drives the economy. Corporations, as we mentioned earlier, as Jimmy mentioned earlier, you come up with an idea, you come up with an organizational structure, you do have to fund that. So companies need to build new factories. Developers, real estate developers, and other people who invest in real estate need to build office buildings, apartment buildings, shopping centers. Corporations borrow to buy other companies. A couple of years ago, Warner Brothers, the famous Hollywood movie studio, was purchased by AT&T. AT&T felt that this would be a strategic area of growth for them, and AT&T borrowed money in the financial markets in order to finance that purchase. And also, and this is the core thing, and we're going to talk about this a little bit more later when we talk about IPOs, but you help finance new products and new ideas and new services. And innovation and the funding of innovation is maybe the most important thing that the capital markets do. A lot of the technologies that we have today, even simple things like cable TV, mobile phones, weren't necessarily around 30 or 40 years ago. At some point, somebody went to the capital markets to fund their companies and to create all the great services and technologies that we enjoy today. So On the other side of it, as we've been saying, the individual with cash meets the person who needs cash. Why do individuals invest? As we've been saying, save for a down payment on a house, pay for college, retirement, increasing their wealth by investing extra cash into stocks and bonds. Those of us who are fortunate enough to have extra capital that they don't need to spend for day-to-day needs tend to save it, or most of the wise people, of course, save it. Some people do other things, but you can increase your wealth by investing in equities. You can make income by investing in bonds. So that's a significant source of investment capital for the rest of the world. And I think we've talked about the fact that pension benefits are paid to workers when they retire by pension funds. Insurance benefits are paid to people when they make a claim. And of course, many financial institutions like Morgan Stanley, for instance, you invest with them so that they can make money for you as a client over the course of time. So that's why institutions invest. To kind of start maybe closing it out and looking at the types of financial instruments that we have in the financial markets, the two main instruments are stocks and bonds. Equities and fixed income is a more fancy term for both, but stocks and bonds. So let's just take a quick look at each one. So stock markets around the world let people invest in companies that they believe will grow and prosper in the future. Both Jimmy and I will talk about this more a little bit later, but the reality is, picking a company that you think will grow and will do very, very well in the future is tough. You have to believe in the management, you have to believe in the products. But the idea is to buy something at 100 right now and hopefully sell it at $1 million in the future, or buying Apple and hoping that it goes up significantly in price, as we'll see in a moment. So stocks, also known as equities, are actual ownership products that give you a very small fractional ownership of a company. So, and this is kind of based on current numbers. So today, or earlier this week, if you bought 1,000 shares of Apple, you owned 0.00000023% of the company. It's very tiny. Obviously, it's almost insignificant, but you are indeed an owner of Apple. You might not own as much as Tim Cook or a big mutual fund or the Jobs family, but you are still an owner. And that ownership gives you certain rights. You participate in the growth of Apple if the company continues to do well. You earn dividends. Extra profits that management doesn't need to fund the company are paid to stockholders in the form of dividends. And these things are important to many investors. A lot of investors live off dividends. So, and you also have rights, voting rights in many countries. Not to say all countries are not all the same, but in many countries you have voting rights, and you can help pick the board members, the CEO, the senior management of the company. It's no different from if a friend is starting a restaurant or a dry cleaning store or a pet shop or whatever, and you give them some money, and the friend gives you 25% of the company, 15% of the company, whatever it might be. That ownership might be more significant, but it's the same concept in the public marketplace. So that's the equity market. That's the stock market. And by the way, the stock market, things have moved around lately, but let's say the stock markets globally are worth about $80 trillion. So there's a huge amount of wealth in the stock market. So let's move towards wrapping this up by talking about the bond markets. Bond markets put together people who wish to lend money now and receive it back at some point in the future. The lender receives interest. And a good way to think about interest is a rent that you pay to borrow money for a certain period of time. Okay, it could be a month, could be a year, could be whatever. Oops, sorry about that. I kind of hit the wrong button there, and I apologize. So where were we? So interest is the rent that you pay on the use of capital for a certain period of time. Okay, and the rent that you pay for dollars might be a little bit different from yen. Yen might be a bit different from pound sterling, but it is what you pay the lender for using money for a certain period of time. So bonds are really like loans that need to be paid back. So let's say you have a friend, and your friend says, "Hey, can you loan me $20 today, $20 today?" And the friend says, "I'll pay you back in a month, and I'll give you $2 in interest." So a month later, if everything goes well, and your friend shows up and he's an honest person, you get your $20, which is your principal, and then you get $2 in interest. Now, bonds are a little bit more complex than that because you can trade them. And actually, we have on the screen here an old-style U.S. Treasury certificate from mid-20th century, actually 1978, 79, and I think is the approximate issuance of that bond. That bond, you can take that certificate. Nowadays, they're in electronic form, and you can sell it to somebody else. we get more into this when we do the full course, which we hope you join us for in the near future, because some of this stuff is a bit time consuming, complex, but is something we will address. Jimmy's sections will expand as well, but we wanted here just to give you kind of a basic introduction to the concepts that we're going to be talking about. So I think with that in mind, I'm going to turn it back over to my colleague, Ashley, and she'll lead us into Jimmy's next segment.